how do you see home prices crash when you have homeowners who are the best position they've ever been in? But do you still feel that way? Do you think there's any chance of a home price crash?
National nominal home prices crashing only happened one time post World War II. That was 2007 to 11. Active inventory in 2007 was 4 million. It's 1.18 million today. We had 4 years of massive credit stress, 2005, 6, 7, 8, rising bankruptcies, rising foreclosures. And the one data line we show everyone out now, like how are home prices still up? Like we were told home prices will crash every year for 14 years. But if you look at the new listings data that we have at Altos Research, in 2008 to 2012, the new listings data, which runs about 80,000 to 110,000 during the peak months, was running at 250 to 400,000 per week for 4 years. Those were forced credit sellers into an underwater marketplace. 23% plus of homes were underwater in 2010. 1.8% of that is right now. 40% of homes in America don't have a mortgage. What we look at, the loan to values were in 2008-9 were 85, 86%. It's 46.6. So homeowners are in a much better spot. If you want to look at pockets of the country, the condo market in Florida, right? Those areas you can see stressed sellers, but on a national basis, it's just really rare. It's rare for home prices to fall nationally on a nominal basis. If I take 2007 and 11 out of the equation, it only happened 1 year. It's 1990. That was 1%. So active inventory is still not back to normal. Normal using the NAR data is 2 to 2.5 million. We're at 1.18. So we're just trying to get things back to normal. And the variable that people have to think is that whenever rates fall, demand picks up a little bit and pricing tends to firm up. That's how I lost my price forecast last year. Last year, I had 2.33% nominal home price growth. And when rates fell during the middle part of the year last year, what it did is it firmed up demand because active inventory is still not back to normal. And prices firmed up in this seasonal soft period of times, and home prices ended up 4%. You have to look at it in that way. We do have models to work with national home price crashes. We just don't see those same variables in there.
I wanted you on the show is to just try to bring some sense to our listeners who are afraid. They maybe have lost a lot of money in the stock market. They're mostly real estate investors listening to this show and wondering if it's going to hit their real estate portfolio too. We talk regularly about the lack of housing, and you've got a whole lot of people who own homes who are actually in a pretty darn good position because they've got equity, they've got fixed rate mortgages, they have had at least good credit when they got their properties. I think the fear for our listeners would be, what if they all lose their jobs? Who's going to pay my rent?
Well, that's actually some of the explanation for what's been going on in a number of markets around the country where prices are falling. Mm-hmm. And you're seeing, even if they're not falling, what's happening is that the initial price is being cut. And that's happening more and more frequently. And part of that is that despite the fact that people don't necessarily want to sell their houses, so the inventory is still relatively low. What we're seeing in the market itself is the fact that prices went up significantly. And now people who are looking out and saying, gee, I'm hearing about a recession coming. Do I want to buy a house at this particular point, especially where the mortgage rates are? And despite the fact that inflation has come down, mortgage rates are still relatively high. And that's basically because the financial institutions have an inordinately wide spread and are getting a lot more over the Treasury security, where the 10-year Treasury security, where they price it. Let's put it this way so people can understand. You take a Treasury security, and over the last 30 years or so, we've been looking at the mortgage rate, the 30-year mortgage rate, be something like 1.5 percentage points above it. So if the Treasury security was 4.5%, the mortgage rate would be 6%. Okay. Now it's 2.5 percentage points above the 10 years. So you're looking at mortgage rates closer to 7% than 6%. So this wide spread has been maintained, and financial institutions have enjoyed that because they're making a lot of money off of it.
I was just going to say, who's controlling that? The greedy lenders?
Well, I'm not going to call them greedy lenders, but they are enjoying quite nicely
Okay.
the high spreads that and the wide spreads that they're getting. So there is the bad thing about it is the rates they shouldn't be this high. They should be at least a half a percentage point, 50 basis points below where they are, if not more, if we were moving towards a more normal spread. The only good thing about it is that, and we probably would have seen it quite clearly if we did wind up in a recession, and we don't know what's going to happen with tariffs, even after the 90-day pause that we're in at this point. But if the economy does slow significantly, that's going to slow demand for housing, and it may start forcing the financial institutions to narrow that spread. I don't know how fast that will occur, and I don't know how much they'll take it down, but I was expecting rates to fall more as we got closer to the possibility of a recession. Now there's a lot of uncertainty about that. And that's a problem that investors have right now because mortgage rates are really too high if you consider the spread as a measure. And that's a problem facing investors at this point, and people trying to buy and sell houses as well. So.
And the rates would continue to rise if we saw inflation, which is what many people have said will happen with these tariffs. Do you have concerns about that?
Yes, I think what we were all fearing is the ugliest word in the economist lingo is called stagflation, which is stagnation and inflation.
How are you most comfortable investing today?
Yeah, I still love real estate. I mean, I'm sure you would agree with me with what I'm about to say, but real estate is the single best hedge against inflation and probably recession than any asset class on the planet. So if you have to have your money anywhere, if you're concerned about inflation, if you're concerned about the economy, real estate is the right place to have it. Now, there are lots of different ways to invest in real estate. And the two biggest are you flip it, you buy it to resell quickly, or you hold it and you basically you plan to not resell it for 3 or 5 or 10 years. I'm a big fan of during times where we see inflation and economic uncertainty that we're doing strategies that are at least 2 or 3 or 5 years out. I'm not a fan of flipping houses right now. I wouldn't want to be buying a house that I have a 3 or 6 month hard money loan on where I need to get it renovated and resold in 6 months because who knows where the market's going to be in 6 months. It could be a lot worse than it is now. It could be even if it's not the housing market, the economy in general could be worse, which means there could be fewer buyers out there. So I don't like the strategies right now that involve requiring the sale of a house in the next few months. That said, any strategies where you can or plan to hold a property for at least 2 or 3 or 5 or 10 years, I'm still a huge fan of. If you look again at the historic recession patterns, what we see is recessions typically last somewhere between 12 and 18 months. And so if a recession were to start today, let's say, there's a reasonable chance that by 2027, things are back on the upswing, that we're back in the next economic expansion period. And so if you can hold the real estate that you have, if you're buying real estate and you buy it intelligently, you buy it with a mortgage that you know you can pay, you have some reserves on the sideline, that you are being conservative when you model your expenses and your rent growth and your occupancy and vacancy, and you know that you can weather a 1 or 2 or 3 year storm, you can be pretty certain that when you come out the other side in 3 or 5 years, that investment will be worth more than it is today and will probably have stood up better than any other asset class that you could have invested in that time.